In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about how Zee's founding family went from owning 43% of the company to now being voted out by its own shareholders. And in the second story of the day, I'll talk about why ONDC's bold e-commerce experiment is hitting turbulent times now and what that really means for the future of online retail in India. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 16th of July. See, not very long ago, Zee Entertainment was one of India's biggest media success stories. It was our country's first private satellite television network, which was launched back in 1992, which was back when most of India was still used to watch Doordarshan's black and white news broadcasts. But this month, the same company made headlines for a very, very different reason. And this shows just how far things have fallen since then. On the 12th of July, Zee's shareholders voted against a major proposal from its founding family. The Goenka family, who had built the company from scratch, were trying to increase their stake by issuing new convertible warrants, which is essentially a way for them to buy more shares over time. Now, the plan was to raise 2,237 crore rupees and through that take the family's shareholding up to 18.4%. But the shareholders said no. Now, to pass this kind of proposal, Zee needed 75% of shareholders to say yes, but they only got 59.5%. The rest, which is 40.5%, voted against it. Now, mind you, this was not just a routine vote. It was like a statement. It was a message from investors that they no longer trust the very people who started Zee in the first place. Basically, the same family that once used to own nearly half the company now owns just 4% of it. And this latest rejection shows that even the remaining influence is now in a very big question. So to understand why this even happened and why it even matters, we'll have to go back not just a few years this time, but actually a few decades. See, the man who started it all was Subhash Chandra, who's from Haryana. Back in 1973, he was just in his early 20s and he took over a struggling family business that traded in food grains. The company was called Messrs. Ram Gopal Indra Prasad and it was in deep debt. Now, Chandra turned it around and he made it profitable and he rebranded it as SL in 1976. But he was not happy with just running a trading business. Over the years, he ventured into everything, right from packaging and theme parks to lottery businesses and most notably also media businesses. And that's exactly when he launched Zee TV in 1992, which became India's first private satellite television channel. Zee TV is what broke the government's monopoly on broadcasting and it opened the doors to a media revolution in our country. And over time, Zee grew into a massive network of entertainment channels with a global reach. It was a genuine landmark of sorts in the Indian television history at that time. Now, for many years, Zee and SL were seen as sort of shining examples of Indian entrepreneurship after the era of liberalization. But again, behind the scenes, the promoters were slowly losing their grip on the same company. In 2016, the Goenka family, including Subhash Chandra's son Puneet Goenka, held 43% of Zee Entertainment through various SL group companies. But today, like I said, they hold just about 4%. So the question is, how did they even lose almost all of it? See, the trouble actually began long ago. As early as 2001, the family had started selling small chunks of their stake to raise some amount of money. That year, they sold 5 million shares to a US-based investor to pay off over 200 crore rupees in debt. And this, interestingly, was debt that they owed to Zee Telefilms itself. That was the first red flag out here. Promoters borrowing money from the company and then selling the company's shares to repay it is never a great look whatsoever. But this became a pattern. In 2003, they sold another 12.38 million shares, which is around 3% of the company, once again to pay off its debts. This slow dilution kept happening over the years, but the real collapse came in 2019. See, by then, the SL group was buried under 17,000 crore rupees in debt, spread across 88 different companies. For a while, they had managed to survive by borrowing new money to pay off old loans, but that stopped working after the IL&FS crisis hit India's credit markets in around late 2018. Now, to give you some context, IL&FS, which is a major infrastructure financer, defaulted on its payment, which sort of sent shockwaves through the entire system. Lenders suddenly became cautious and rolling over loans was not possible anymore. And that is when SL's debt problem turned into a very big cash crunch. The Goenka family had pledged a huge chunk of their Zee Entertainment shares as collateral to get loans. Now, this is common practice, but the problem is that it carries a lot of risk. If the share price drops, the value of of that collateral drops as well, and lenders can demand more security or repayment. And that is exactly what happened in January 2019. A media report accused the group of moving money between companies to hide the impact of demonetization. And the result was that the stock fell by 33% in one single day. Lenders issued margin calls, and since the family could not meet those demands, they had to sell their shares, and that too very, very fast. Between 2018 and 2020, their stake crashed from 43% to just under 4%. So basically, what started as a temporary liquidity issue of sorts became a permanent loss of control for the company. And over time, things got even worse from there. Shareholders were not just worried about the family's debt problems, they began losing faith in the way Zee was being run. In 2021, two of Zee's largest institutional investors, which is Invesco and OFI Global China Fund, who together, by the way, held about 18% of the company, demanded that Puneet Goenka be removed as managing director and CEO of the company. They claimed that the board had approved a merger with Sony without properly informing shareholders, which raises serious governance concerns. Zee, of course, pushed back, and they refused to call an EGM, saying that investors do not really have the required regulatory permissions. But eventually, two directors resigned and a long legal fight began. The company's leadership was in sort of a limbo, and its credibility was on a very, very shaky ground. And then came the Sony merger, which was potentially a lifeline for them. Now, the plan was to merge Zee with Sony's India business to create a $10 billion media giant. Zee's shareholders would get about 47.07% of the new entity. Invesco supported it, and for a while, it looked like Zee might just pull out through. But in early 2024, Sony called the deal off. They claimed that Zee had failed to meet certain financial terms, including not having enough cash, and that it was not even trying to fix these issues. They accused Zee of making empty promises, and they demanded $90 million as penalty. Now, behind Sony's tough language was something even more troubling. These were ongoing regulatory investigations. See, SEBI had been looking into allegations that the Goenka family diverted funds from Zee to other companies within the SL group. It's a very complicated web, but I'll give you a quick gist of it. See, the family took loans from Yes Bank for some SL firms and gave comfort letters which allowed the banks to take money from Zee Entertainment's fixed deposits in case they failed to repay. And that of course happened. 200 crore rupees was pulled from Zee's accounts, even though the company had absolutely nothing to do with these loans. And later, it actually looked like the money was repaid. But SEBI actually discovered that all of this was just accounting trickery, so to speak. The repayment had been routed through more than 13 shell companies, and the source of the funds was actually Zee or other SL-linked entities. So what looked like a reimbursement was actually Zee just paying itself back with its own money. Now, SEBI suspects that nearly 2,000 crore rupees was moved around in this exact way. In 2023, both Subhash Chandra and Puneet Goyal were banned from holding leadership roles in any listed company, which was a decision that was later reversed, but the damage was already done. In January, SEBI refused to settle the matter, keeping the pressure very much alive. And around this time, shareholders finally ran out of patience. In October 2024, Zee's board tried to reappoint Puneet Goenka as managing director for 5 more years, but proxy advisory firms recommended voting against it, citing weak performance and leadership concerns with him. Now, realizing all of this happening, Goenka himself stepped down as MD a few days before the vote happened, but he still stayed on as CEO, which was a position that did not really require shareholder approval. Then, when shareholders were asked to at least keep him on the board as a regular director, they said no as well. The vote, to be honest, was fairly tight, but it was against him. 50.46% people voted against, and 49.54% people voted in favor. So for the first time ever since Zee was founded, no member of the founding family had a seat on the board. Now that, ladies and gentlemen, is the background for the latest warrants proposal. The Goenkas were basically hoping to use this as a way to get back some stake and influence, but shareholders seem to have had enough. The answer for them was a firm no. Now at its peak, Zee Entertainment represented a bold spirit of India's post-liberalization era, which is an ambitious private player who challenged the status quo and changed what Indian TV looked like to the global world. But again, over time, it became a story of a bit of overconfidence, excessive borrowing, and poor governance. The family behind it lost not just their shares, but the trust of the very shareholders they were hoping to win back. So for now, Zee is basically a company that is trying to move forward without the people who once built it. Now, whether or not the Goenkas can ever rebuild the trust and make a comeback remains to be seen, but for now, the message from shareholders is very clear: not yet. On that note, let's move on and talk about the second story. See, something unusual is going on in the world of Indian e-commerce. Over the last few months, a government-backed platform called ONDC has been making quite a few headlines. Now, for those of you who are new to it, ONDC is a digital network and it is trying to sort of rewrite the rules of how e-commerce works in India. And the big news here is that ONDC has hit a bit of a rough patch. Between October 2024 and February 2025, the number of monthly retail orders made through the platform dropped by 31%, falling to about 46 lakh orders. That is a very sharp decline. And in a sign of how serious things are over here, several top leaders, including the CEO, the chief business officer, and the non-executive chairperson, all have stepped down earlier this year. Now, one of the key reasons behind this drop was a decision ONDC made earlier in the year. It drastically reduced the amount of incentives that it was offering to companies using its own network. To give you context, until then, ONDC had been spending nearly 3 crore rupees every month to encourage adoption for its platform. And that very amount was suddenly cut down to about 30 lakhs, which is about 1/10 of the original amount. And naturally, this made it much less attractive for businesses to participate, and growth slowed down even further. But instead of pulling back, ONDC is now going in the exact opposite direction. It is preparing a fresh subsidy push worth 150 crore rupees. The hope is basically that this boost will reignite interest, will bring new players into the network, and will help ONDC regain the momentum it had last year. But again, whether this new funding round will actually deliver results is a much bigger question, and this is the one that goes beyond just incentives and numbers. So to answer it and understand things in a little more detail here, let's first understand what ONDC is trying to do in the first place. And to understand that, let's take a quick step back and think about how most of us use e-commerce today. See, when you order something from, let's say, Amazon, the experience feels fairly seamless. You search for an item, you click for the product you like, you pay on the same app, and a few days later, or a few hours later for that matter, the package is at your doorstep. But of course, behind the scenes, Amazon is doing a lot more than just connecting you to the seller. It controls almost every part of that journey. It hosts the product listing, it processes the payment, it stores the products in its warehouses, and it even delivers it using its own fleet. So in other words, Amazon owns the entire chain, right from product discovery to last mile delivery. And this gives Amazon enormous power. For example, sellers usually pay Amazon just so that they can show up in their search results. And those who pay more are likely to appear even if they are not the most relevant to what you might be looking for. So in a way, Amazon sells the digital equivalent of a prime retail space. And because it knows everything about your shopping habits, which is what you browse, what you buy, and how long you spend on each product, it can use that data to sell your attention back to the sellers. Now, of course, all of this is not unique to Amazon. This is just an example. Whether it is Uber or Swiggy, many internet platforms today operate in almost the exact same way. They are technically just intermediaries where they connect buyers and sellers, but because they actually own the full pipeline, they end up controlling the entire experience. And in doing so, they become the most powerful players in the ecosystem. Now, ONDC was created to challenge that very model. The idea behind ONDC is very simple but very ambitious. What if no one company could control the entire chain? What if every part of the e-commerce experience like search, payment, delivery, etc. could be handled by a different player? What if somebody could build a platform just for listing products while somebody else handled payments and a third company altogether would focus only on delivery? And what if all of them could sort of plug into a common open network? That was exactly what ONDC was trying to build. You can think about ONDC as a public road system of sorts. Anybody can build and drive a car on it. They can open a petrol pump also, but the very road, which is the basic infrastructure, belongs to everybody commonly. Now, in this case, ONDC is building that digital road. It connects different companies that specialize in one part of e-commerce so that all of them can work together. You don't need to be an Amazon to sell online anymore. You can do one thing really well and you can still be a very important part of the system. Now, the technology that's behind all of this is based on something called the Beacon protocol, which is a kind of common language that allows different parts of the system to talk to each other seamlessly. Now, there are broadly 5 roles in the network. First, there are buyer apps. Now, these are the ones that users interact with, like the front end of an Amazon or a Zomato. Second, there are seller apps, which are platforms that connect with businesses and bring in their product listings onto the platform. Third, there is something called a gateway, which is the price that matches buyers with the most relevant sellers based on the request. Fourth, there are technology service providers. Now, these are companies that offer back-end technology solutions like billing, inventory tracking, or customer support. And finally, fifth, there are logistics providers, which are people or companies who physically deliver the item. Now, ONDC, of course, does not do any of these things individually. It just connects all of these dots. And in theory, this model has some very big advantages. It could lower costs because since no company controls the full stack, commissions could be fairly smaller. Because when Zomato might charge a restaurant 18 to 25%, a similar sale on ONDC might cost, say, only about 10%. 1%. It could also make product search much more neutral since there is no central gatekeeper who's controlling what you can see. And it also opens the door for many small players to participate, especially local businesses and kirana stores. Now, for a while, it seemed like this idea was working very well. In early 2023, ONDC was barely processing 50 transactions a day, but by August that year, it had hit 1 lakh daily transactions. Seller numbers also grew from 800 to more than 1.4 lakhs. But beyond that as well, the biggest success story was in the space of mobility. A ride-hailing app called Namma Yatri, which works a bit like Uber but does not charge commissions, saw huge adoption over here. Basically, over 3 years, it handled 10 crore rides and it helped auto drivers earn 1,600 crore rupees. Its zero commission model forced even big giants like Uber to start rethinking on their pricing fronts. And if you talk about retail, the biggest traction came from food delivery. ONDC grew from 4,000 monthly food orders in March 2023 to 5 lakh monthly orders by March 2024. That, of course, is a very big leap. Restaurants were specially attracted to the platform because they were frustrated with the steep commissions on Swiggy and Zomato and the likes. So ONDC offered them a cheaper route and even helped ride-hailing apps step into food delivery. But again, a lot of this growth was heavily subsidized. ONDC was footing the bill to keep prices low and to attract new users. And once all of these subsidies were reduced, the orders started to fall down like I mentioned. In fact, some big players like PhonePay's PIN code app exited the ONDC network altogether. So the thing is, while the platform definitely had a very big boost, it's very clear that the traction was not fully organic. And that brings me back to the main issue that I'm talking about, which is, can ONDC really work at scale in the long run? See, there are some serious challenges, and the biggest one lies in ONDC's core idea, which is unbundling. See, when you separate each part of the e-commerce experience, you make it a lot more flexible, but the problem is that you also introduce a bit more friction. Who is responsible when something goes wrong? Say, for example, you order a pizza through an ONDC buyer app, but the seller app has incorrect inventory and the delivery partner never shows up to your doorstep. Who do you really blame? And who do you call for help? Now, in a traditional platform like Zomato, it's fairly simple. Everything is bundled into one. So you can raise a complaint and Zomato will handle the rest of it. But with ONDC, there is no one single party that is accountable for the full chain. And that obviously creates a lot of confusion. In fact, there was a survey done by local circles where about 35% people said that they were unhappy with ONDC's grievance redressals. That is not a small number. But even apart from that, different use cases on the application require very different levels of integration. Food delivery, for example, depends on real-time inventory, live tracking, and very tight coordination. And mobility, on the other hand, requires very different features altogether. Now, ONDC tries to be everything for everyone, but that can really come at the cost of quality in every single category. Because in trying to become universal, it sometimes becomes too generic. And there's another catch, by the way. ONDC does not have the margins to absorb all of these inefficiencies. Big platforms like Amazon and Flipkart might lose some money on one part of a transaction, but they could make it up anywhere else. They can also optimize across the stack because they can use better data, they can fine-tune delivery routes, and they can build smoother experiences. But with ONDC, every single piece is run by a different player, and the room for such coordination is very, very limited. So the end result is that while ONDC might be cheaper in theory, it is actually far more clunkier in practice. Many apps that actually use ONDC honestly feel a bit underwhelming to use. More than half the users in one survey said that they found interfaces very confusing, and once the price advantage disappears, users don't really have any reason to stay as such. Now, to be fair, ONDC obviously knows this, and that is why they are launching this new 150 crore rupee subsidy plan. But again, subsidies alone may not really fix the core issues, because for ONDC to work, it needs to become more than just a cheaper option. It has to offer better features, smarter tools for sellers, and maybe even easier experiences for users. There's also a very different path it could take, where instead of trying to compete with an Amazon or Swiggy directly, ONDC could actually double down on niches where it already has an important edge. It's done a good job bringing local sellers and small stores online for sure. Maybe it can build new digital ecosystems around these players instead of actually just trying to take down the giants head on. But anyway, no matter what direction ONDC takes, one thing is very, very clear. In just 3 years, ONDC definitely has made enough of an impact that it is unlikely to disappear anytime soon. But the thing is, how it ends up reshaping India's e-commerce is a very, very big question that is still very wide open. That brings me to the end of the 2 stories of the day. On that note, let's move on to the final section and talk about the quick news headlines. First, we looked at how India's CNG sector is facing a bit of a squeeze. Demand is still growing, but supply not so much. But now there seems to be some relief. GAIL has signed a long-term LNG supply deal with Vitol Asia, locking in 1 MTPA of LNG for 10 years starting 2026. This deal is part of GAIL's push to strengthen its long-term portfolio and insulate customers from short-term shocks in domestic gas production. Second, sometime back we'd explored Reliance's entrance in India's $18 billion soft drink war with Campa Cola. Now that push has seemed to cross borders. Campa Cola has launched in Nepal. Through a partnership with Chaudhary Group, the country's largest conglomerate, Reliance, has officially taken its heritage brand global. This comes after its earlier foray into GCC markets, and this move aligns with RCPL's strategy to price aggressively and scale very quickly. In Nepal, 250 ml Campa Cola bottles are priced at Nepalese rupees 30, which significantly undercuts global rivals. Third, Viridium International Seaport in Kerala, after a successful first year of operations, is set to embark on its second phase of expansion starting September 1st, 2025. The 10,000 crore rupee project aims to enhance capacity and connectivity, positioning the port as a key player in India's maritime infrastructure. Fourth, India's inflation rate seems to be cooling down majorly. India's retail inflation has dropped to a 6-year low of 2.1% in June 2025, which is driven by easing food prices. Now, this decline raises some level of expectations for one more rate cut by the Reserve Bank of India to stimulate economic growth. Fifth and the final one for the day, India has achieved a significant milestone by reaching 50% of our installed electricity capacity from non-fossil fuel sources 5 years ahead of our 2030 target under the Paris Agreement. That's all the news and stories I have for you today. I hope you enjoyed this episode. This is your host Anurag Bansal signing off. Take care and I'll see you tomorrow. Bye-bye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.